Profiting from the R3 trading strategy. The R3 trading strategy is a momentum-based, price-action-driven approach that focuses on identifying high-probability intraday and short-term trading opportunities around key pivot levels. Among active traders, especially day traders and short-term swing traders, R3 has earned a reputation as a precision strategy that blends structure with flexibility. Rather than relying heavily on lagging indicators, the R3 trading strategy emphasizes market context, volatility, and institutional price behavior, making it especially attractive in fast-moving markets. At its core, the R3 trading strategy is built around pivot point theory, specifically the third resistance level, commonly referred to as R3. Pivot points are calculated levels derived from the prior trading session's high, low, and close. These levels are widely used by institutional traders, market makers, and algorithmic systems, which gives them real-world relevance and liquidity. The R3 level represents an extreme resistance zone, where price is statistically stretched relative to the session's average range. When price reaches R3, it signals that the market is either experiencing unusual strength or is entering a zone where mean reversion or exhaustion is likely. The R3 trading strategy capitalizes on this imbalance between price expansion and market participation. The importance of the R3 level lies in probability and market psychology. Most trading sessions do not reach R3 under normal conditions. When price does push into this area, it often occurs due to news catalysts, short squeezes, or strong directional momentum. This makes R3 a level where emotions peak, liquidity thins, and professional traders look for asymmetric risk opportunities. In the R3 trading strategy, traders are not blindly fading strength or chasing breakouts. Instead, they assess context, including volume behavior, time of day, and overall market sentiment. This structured approach allows traders to align themselves with high-quality setups rather than reacting emotionally to price spikes. Just a quick reminder to please hit the like button and subscribe to the channel for more content like this. Also, you can visit us on the web at investmenttees.com and use code BLOG to receive 20% off your next purchase. The R3 trading strategy performs best in volatile, active markets. These conditions typically occur during earnings season, macroeconomic news releases, or periods of heightened market uncertainty. Stocks with high relative volume, strong pre-market movement, or significant news catalysts are particularly well suited for R3 setups. Choppy or low volatility markets are generally less favorable. Without sufficient momentum, price is unlikely to reach R3. And even if it does, the move may lack follow-through or clean structure. Successful R3 traders are selective, focusing only on instruments that demonstrate clear directional intent and above-average participation. Volume is a critical confirmation tool within the R3 trading strategy. When price approaches R3 with declining volume, it may signal exhaustion and a potential reversal. Conversely, expanding volume near R3 can indicate strong institutional interest and the possibility of a continuation move. Momentum indicators, while not required, can help traders gauge strength versus sustainability. However, the strategy itself is not indicator-dependent. The emphasis remains on price behavior, such as rejection wicks, consolidation patterns, and the speed of price movement as it interacts with the R3 level. Execution within the R3 trading strategy varies depending on whether the trader is looking for a reversal trade or a momentum continuation trade. In reversal scenarios, traders look for signs that price is failing to hold above R3, such as strong rejection candles or rapid loss of momentum. Entries are often taken after confirmation, not at the exact R3 level. In momentum-based R3 trades, traders wait for price to break and hold above R3, followed by a controlled pullback. This approach assumes that unusual strength is present and that price may continue to expand beyond traditional pivot expectations. Both approaches require discipline, patience, and precise risk management. Risk management is non-negotiable when trading R3 setups. Because R3 represents an extreme price level, false breakouts and sharp reversals are common. Professional traders define risk before entering the trade, typically using a tight stop loss just beyond the invalidation point of the setup. Position sizing is equally important. The R3 trading strategy is designed to offer high reward to risk ratios, but only when risk is controlled. Traders who oversize positions or ignore stop-loss rules often experience unnecessary drawdowns, even if their market analysis is correct. R3 trading strategy example. Imagine a stock that gaps up significantly in pre-market trading due to strong earnings results. The stock opens with heavy volume and continues trending higher during the first hour of the session. As the day progresses, price accelerates and approaches the R3 pivot level, which lies well above the session's volume-weighted average price and prior resistance. As price reaches R3, volume begins to spike, but the candles show long upper wicks, indicating selling pressure. The stock attempts to break higher but fails to hold above R3. A strong bearish engulfing candle forms, confirming rejection. A trader using the R3 trading strategy enters a short position after this confirmation, placing a stop loss just above the session high. Over the next hour, price mean reverts toward volume-weighted average price as late buyers exit their positions. The trader scales out profits along the way, achieving a favorable risk-to-reward outcome while maintaining strict discipline. This example highlights how R3 functions as a decision zone, not just a static level. While powerful on its own, the R3 trading strategy becomes even more effective when combined with overall market structure, such as index direction, sector strength, and sentiment indicators. Aligning R3 setups with broader market flows increases the likelihood of follow-through and reduces random outcomes. Experienced traders often use R3 as a filter, not a standalone signal. They wait for alignment between price action, volume, and market conditions before committing capital. This layered approach separates consistent traders from reactive ones. Conclusion: the R3 trading strategy is not a shortcut or a guaranteed win, but it is a highly effective framework for identifying asymmetric trading opportunities around extreme price levels. By focusing on pivot-based structure, volume confirmation, and disciplined risk management, traders can position themselves where probability and psychology intersect. Traders who take the time to understand context, wait for confirmation, and manage risk responsibly can absolutely profit from the R3 trading strategy. Like all successful trading approaches, consistency comes from execution, patience, and continuous refinement. When applied correctly, R3 becomes more than a level on a chart, it becomes a strategic edge in competitive markets. Thank you for watching.